Welcome to the Daily AI News Digest. Today is August 11, 2026, and this broadcast is sponsored by bestai.org. In today's explainer, we're taking a strictly objective, numbers-driven look at the current market realities defining the artificial intelligence sector. We'll be cutting through the noise to examine the massive capital deployments and infrastructure shifts that are actually driving this industry forward. Right now, the financial foundation of AI is rapidly transitioning. We're moving away from venture-backed speculation and straight into institutional infrastructure, debt, and sovereign industrial policy. Over the next few minutes, we'll unpack the audited numbers, the firm corporate commitments, and the benchmark realities that are currently dictating the actual unit economics of the landscape. Let's start with our first segment, the biggest moves today in capital and infrastructure. We are tracking a $500 billion financing pool forming for AI compute infrastructure. Nvidia has just finalized agreements with 6 major Wall Street firms, including Goldman Sachs, BlackRock, and Apollo. Crucially, Nvidia holds an option to backstop up to 25% of these transactions. To put that into perspective, that's a $125 billion corporate commitment to ensure enterprise clouds and sovereign states maintain access to high-end hardware. Looking at Broadcom, their Q1 fiscal 2026 results deliver a very clear market signal. AI semiconductor revenue alone surged 106%, hitting $8.4 billion for the quarter. These are raw audited numbers, driven heavily by custom ASICs chips, which is hardware tailored for specific workloads, and Ethernet networking deployments that are now directly competing with legacy standards like InfiniBand. What's really crucial here is the durability of Broadcom's revenue pipeline. We aren't just looking at broad market GPU sales. This is built on locked-in, multi-year custom silicon partnerships. The roster is heavy: Google, Meta, Anthropic, OpenAI, plus 2 undisclosed hyperscalers. Notably, OpenAI is expected to deploy its first-generation custom accelerator at over 1 gigawatt of compute capacity in 2027. That is an energy footprint roughly equivalent to powering a medium-sized city dedicated entirely to AI processing. Meanwhile, Intel is executing a strict tactical pivot. The chipmaker has upsized its public stock offering to $20 billion, priced at $95 a share. This capital raise is earmarked strictly for accelerating domestic foundry tooling and advanced packaging lines. It's a calculated move to satisfy a growing external customer demand pipeline without having to rely solely on debt. Moving on to Section 2, let's look at product and model realities. If we check the Bench LM August 2026 leaderboard, Anthropic's Claude Mythos 5 currently leads the frontier with an 83.04 composite score. However, we're seeing severe compression at the top. More importantly, open-weight models like Minimax M3, which allow developers to download and modify the core architecture, are shifting deployment economics. By self-hosting these models, engineering teams are effectively trading a few benchmark points for a cost structure completely free of per-token API fees. That exact tension between heavy cloud reliance and local deployment was highlighted yesterday by Meta's release of Muse Glimmer. It's a roughly 30 billion parameter open-weight agentic model, meaning it can independently execute multi-step tasks. At this size, it's compact enough to run locally on a single standard graphics card. This allows developers to bypass cloud infrastructure entirely for end-user execution. But when models do run in the cloud, inference efficiency is the metric that matters most. Nvidia's Nemotron 3 Nano Omni is currently achieving 323 tokens per second in external measurements. It gets there through a sparse mixture of experts architecture. Think of it like routing a query to a dedicated specialist rather than briefing the entire company. It only utilizes 3 billion active parameters out of its 30 billion total during inference. This drives down the compute required per output token and fundamentally alters the latency budget. Now for Section 3, regulation, policy, and business signals. Looking internationally, South Korea just launched a massive $880 billion sovereign fund to secure dominance in next-generation memory architectures like DRAM and NAND. On the corporate side, AMD has acquired Thales. This signals a clear pivot toward rethinking AI inference by building hardware natively around specific models, optimizing those workloads right at the silicon level. Which brings us to the most anticipated financial event of the year, the OpenAI initial public offering. Cutting through the market excitement, the structural milestones are what actually matter here. The company filed a confidential S-1 in June 2026, targeting a Q4 listing window at a reported $1 trillion valuation. Crucially, the public markets will have to weigh this valuation against a timeline where the company does not project absolute cash flow positivity until 2030.
let's transition to the analyst's take, zeroing in on unit economics.
Broadcom's CEO Hock Tan recently stated they have line of sight to achieve AI revenue from chips, just chips, in excess of $100 billion in 2027. This quote visually anchors a stark market reality. Right now, the hardware providers, the picks and shovels of this sector, are the primary audited beneficiaries of the current AI capital expenditure cycle. Conversely, when we look at the software and model layer, OpenAI's leaked financial realities present a rather complex picture for an IPO. Yes, annualized revenue has grown rapidly to roughly $24 billion, but their gross margins sit at just 33%. For context, typical software IPOs command gross margins well above 70%. This, coupled with an estimated $14 billion loss for 2026, shows they are currently operating with the capital intensity of a heavy infrastructure company, not a high-margin SaaS platform. The central feedback loop of the sector right now is this: staggering infrastructure costs are front-loaded, and they precede any long-term profitability. Soon, the public markets will have to reconcile an estimated $600 billion in compute commitments through the end of the decade, against constrained software margins that are dictated by those exact compute costs. Finally, our outro and what we are watching next. Here's what is on the immediate horizon. First, the U.S. Department of Energy's Genesis Open Models Initiative has critical data submission deadlines coming up on August 14th and 25th. Second, the South Korean parliament is set to vote on the Mega Special Zones Act, which is designed to bypass environmental reviews for new semiconductor complexes. And lastly, the market is bracing for the unsealing of OpenAI's S1 prospectus. That document will formally expose their exact cost breakdown and their licensing agreements with Microsoft. As model intelligence continues to converge at the top, we're seeing market value shift toward open-source scaffolding and highly efficient local infrastructure. Thank you for joining us for this explainer on today's market realities, sponsored by bestai.org. We leave you with this final thought. With a $600 billion infrastructure bill coming due for the industry by 2030, which software companies will actually generate the margins to pay for it? We'll see you next time.